Have you ever just stared at the market and felt completely lost? You do all the homework, you watch the news, but you have absolutely no clue if a stock is about to shoot up or fall off a cliff. It's really the biggest challenge for any trader, right? Well, let's dive into a strategy that was literally designed for that exact problem.
So let me ask you a question right off the bat. What if you could actually make a profit even if a stock's price goes, well, basically nowhere? Imagine it just drifts sideways, day after day. It sounds kind of strange, but that's the whole idea behind this world of non-directional trading.
And here's why that question is so incredibly important. According to some research, markets actually trend sideways a staggering 70% of the time. Just let that sink in. The vast majority of the time, there isn't some big, obvious trend up or down. So if your only strategy is to bet on direction, you're essentially sitting on the sidelines for most of the game. Okay, so here's our game plan. We're going to start with that big prediction problem, then we'll break down what delta neutral actually means. We'll look at a few strategies in action, uncover the hidden dangers, and finally, we'll ask what this all means from a pro's point of view.
All right, let's get into it, starting with that core frustration that, let's be honest, we've all felt. This idea that you can perfectly time the market. For most of us, it's pretty much a myth. And that's exactly why these kinds of strategies even exist in the first place.
I mean, trader Brian Terry just nails it with this quote, right? That feeling of pure uncertainty is universal. And you know what? A lot of really successful traders eventually just give up on trying to predict the future. Instead, they focus their energy on strategies that don't depend on being right about which way the market's headed.
And that leads us right to the solution they often land on: delta-neutral trading. Think of it as a really clever way to try and take all of that directional guesswork completely out of the equation.
So to really get this, we've got to talk about one key term: delta. Now forget all the complicated math for a minute. The easiest way to think about delta is as a simple score. It just tells you how much an option's price is expected to move for every $1 move in the actual stock. That's it. It's a pure measure of your directional risk.
And here's what that looks like in the real world. If you buy a stock, you've got a positive delta. You want the price to go up. If you short a stock, betting it'll go down, you've got a negative delta. Pretty simple, right? But options, that's where things get interesting. A call option, which is a bet the stock will rise, has a positive delta. And a put option, a bet it'll fall, has a negative delta.
So, here it is. This is the whole magic trick. The entire goal of a delta-neutral strategy is to combine these positive and negative forces, all these different bets, in such a way that they perfectly cancel each other out. Your total delta becomes zero. And if your delta is zero, well, in theory, you're totally immune to which direction the price moves.
Okay, so that's the theory. Sounds pretty cool. But how in the world does it actually work in practice? Let's take a look at how traders actually build these positions to get to that perfect zero delta balance.
One of the most classic, most straightforward ways to do this is with a strategy called the long straddle. It's really one of the foundational delta-neutral positions.
And the setup is just beautifully simple. You buy a call option and you buy a put option on the exact same stock. And here are the keys. They have to have the same strike price and the same expiration date. If you do that, the call's positive delta and the put's negative delta should start out pretty darn close to balancing each other out.
Now, hold on. Let's pause on the straddle for just a second and look at a slightly different example of this balancing act. This image here shows a purchased call option versus a written or short call option. See how the one you buy has a positive delta and the one you sell has an equal and opposite negative delta? The core principle is exactly the same. You're just combining these opposing forces so they add up to zero.
And the straddle is really just the beginning. Traders have this whole toolbox of other strategies, things with wild names like Iron Condors, butterflies, calendar spreads, all designed to create positions that are neutral. Each one just has its own unique flavor of risk and reward.
But, and this is a huge but, here comes the critical twist. Being delta-neutral is absolutely not the same thing as being risk-free. See, you're not getting rid of risk. You're just trading one kind of risk for a whole bunch of others.
Honestly, if you take one thing away from this, let it be this. Just because you hedged away your exposure to price direction does not mean you've gotten rid of all the risk. Far from it. You're now exposed to a whole new set of complex risks that are often totally invisible to beginners.
So, the first danger, it happens right at the starting line. A delta-neutral trade needs both sides to be opened at almost the exact same time. Any delay, what traders call slippage, means you didn't get the prices you planned on, and your position isn't really neutral from the get-go. The entire foundation can be ruined in milliseconds.
Next up is a really big one, margin risk. Your broker's exchange doesn't see your clever, balanced strategy. It just sees two separate trades. So if the price makes a huge, violent move, one side of your trade can get a margin call and be completely liquidated. And just like that, poof, your hedge is gone and you're left with massive, terrifying, naked, directional exposure.
And in the crypto world, these strategies are often used to collect something called funding rates. They're basically just payments between traders. But the danger is, those rates can flip on a dime. The thing that was your profit engine can suddenly turn into a cost, just draining money from your account every few hours. And it doesn't stop there. You solved for direction. Great, but now you've got a whole new set of worries. There's the risk that your perfect balance falls apart way too fast. That's called gamma. There's the risk from time itself, the clock just ticking down as your options lose value every single day. That's data. Basically, you've traded one big, simple problem for a handful of smaller, much more complicated ones. So all of this brings us to the final and maybe most important question. What is this strategy really for? Is it some kind of magic money-making machine, or is it something else entirely?
Well, the appeal is pretty obvious. You see numbers like this. One trader reporting that a portfolio of these delta-neutral trades returned 118% year-to-date. That's the kind of thing that draws people in, making it seem like a powerful engine for massive profits.
But now let's contrast that with a more academic view. This research concludes that the strategy's main job is that it does reduce loss in investment. See the difference? That frames it not as some aggressive profit-seeking strategy, but as a defensive one, a shield for managing risk.
And really, that's the core puzzle of delta-neutral trading. Is it a secret weapon for making money when the market is flat? Or is it fundamentally a sophisticated tool used by pros to hedge, to protect, and to reduce the risk of loss in a much larger portfolio? The truth is, the answer probably depends entirely on who's using it and why.